Good morning, Dan, to you. Let's talk about the setup right now for the economy in the U.S. and abroad and how the markets are treating it. Is this a scenario where the economy can justify the markets at these near record high levels?
It gets very difficult, Dom, without having a trade deal. Trade right now is a tax. It's a tax on consumers and businesses. If that tax goes away, it's like a pile of dry wood, but it's been raining. When the rain stops, the fire's going to get lit, and I think this economy can really accelerate going into next year.
So if it is a case where you're thinking to yourself, this could be an event and it's driven mainly on trade, is it fair to then try to adjust your allocations, your performance, your trading around trade headlines? It seems as though there have been some whipsaws in the action. You can't really trust any one headline. So can you make those decisions based upon your expectations for trade? And should you be making those expectations for trades based upon those?
That's a very difficult thing to do, but we've written a paper, and it's available on our website at palisadecapital.com. My colleague Will Potter and I, along with senior members of our risk team, basically wrote a strategy piece on how to position your portfolio and what key performance indicators, the financial metrics you should zero in on.
So take us through that then. I mean, so you've taken the time to put together this report, this research for your clients. What are the big takeaways? How exactly do you position from a strategy standpoint, given what we know or don't know about China trade?
We start with companies that generate excess cash. You have to start there because if you're going to go into a period where things get really bumpy, you're going to want to have those companies that can weather through that environment and actually take advantage of an environment where others are perhaps denied capital. Right now, you've got high yield and high grade bond spreads at record tight levels right now, but we're looking at companies that are functionally self-funding. The best metrics that have proven to us to be whether through good times and bad times is return on invested capital. And we show in all periods, 5, 10, 15, 20, 30-year periods, that if you focus on companies that have high ROIC, they outperform the underlying
So
index.
What kinds of companies are they then? I mean, are there specific names you're looking at, specific parts of the industrial group or sectors overall that you're looking at? Which ones are there?
We're really industry agnostic, though we have not found real value in the energy space right now because those companies don't cover their cost of capital at this point, and they are somewhat highly levered, and they're not disciplined in their capital allocation. That's another very important part of our analytical process, is to find businesses where there's a culture in the business of allocating capital in a very positive way. The energy industry, unfortunately, has been undisciplined in terms of how they've allocated capital.